Good evening, everyone. I just wanted to check and see if you could hear me. If you could type in the chat box, I would appreciate it. Awesome. Now let's turn on the video. Can everybody see that? Is it loading well? Is it worth its time? Do you really not want to see my ugly face? Sometimes I think it helps with the points of emphasis, but up to you. Okay, great. Everybody's getting it? Great. Awesome. Well, let me get started on the next phase. Uh-oh. They always change these things around all the time. They're just trying to make my life hard. All right. Well, can everyone see the PowerPoint that I have open? And no, Erica, I can't see you. I probably could if I wanted to, but just we have a lot of students and not so much bandwidth. I'll tell you what, if it's really slow, Christy, I'll just turn off the video. Okay, let's just turn that off and see. Is that better now? Can you, if you don't want to watch me, it's okay with me. But hopefully everything's going well. You can see the PowerPoint and you can hear me well. Okay, great. Thanks, Sharon. All right. Well, let's get started. I'd cover 2 or 3 things. The doc sharing access has been a little on and off and spotty this week. I apologize for that. We have some formatting needs for one of our students that we want to accommodate 100%. And the university is formatting a lot of the PowerPoints in those to make it accessible for that student. And I think in the mix they have kind of been turning on and off some access to some of the things that I thought were available to you in doc sharing, or should have been available to you in doc sharing. That's something we will watch quite carefully in the future to make sure that everybody has great access to all the material. And so you will notice sometimes it will say formatted. You may or may not want to use that version. You may want to use a different version, the original version. Next, hooray to Lions football. We're really proud of them and what they did in Alabama this week. And hopefully the rest of our athletic teams have similar success in their upcoming seasons. But I think football is fun because there's so many players, so many band members, etc. involved. There's just a lot of members of the university that are involved at one time, so it's a good spot. So go Lions football, really proud of them. The time for the lecture next week will be changed. I do not know when. I will be in a place that will not have an internet connection on Tuesday evening at 6:30, and so I will not be able to hold the lecture at that time. And I will get back to you later when I know more about that. One other thing, we now have a class graduate assistant or teaching assistant, Bo. This is Bo's actual name here, but she goes by Bo. And so I think it makes it easier. She doesn't have to tell people how to pronounce her name all the time. And but do your best to please always copy her on all emails, as I can be hard to reach and access at times. And hopefully if you copy her, we can be much more responsive to your emails. And particularly if it relates to homework or being late on something like that, since she's going to be grading the homework, it's really important that she stays in the loop. And by the way, to me this seems like a really simple request on my part. Copy the class GA on the email. It's stunning to me how many times people don't do that. You only want to poke me so many times, okay? All right, this week your lecture is coming to you from Boston. And yes, this is Boston Harbor, and you see that little green dome right there. I'm sitting up right in here right now. I'm here for an investor conference this week, which is where you would come and present to investors who might want to invest in the stock of your company. And this happens to be a transportation investor conference held by an investment bank called Cowen, C-O-W-E-N. If you ever want to keep up with any of that kind of stuff, you can just go to, let me do this. You can go to the following. That website right there, that's my company. And then there's a news tab on there that you can go into, operational news or investor news, and it will have conference calls, PowerPoints, all the presentations that we make. So I had a conference call today, for example, with our investors on a recent acquisition that we announced today. If you're bored enough to watch that, you might be interested. Here's another view of the same Boston Harbor, and I'm still sitting right up in that little green dome. I'm sitting right up in here teaching at Texas A&M Commerce from Boston. So typically, folks, this is where I would review your homework so you can know what you did right and wrong and how to get better. But unfortunately, we have a lot of students that just haven't gotten all of their access working appropriately as it relates to just being able to review the lecture where I explained how to do the homework. So I don't want to sit here and do the homework and show you all the answers because those people haven't turned in their homework yet, which is one of the reasons that I really, really, really need everybody to turn in their homework on time, because it's just not fair to the rest of the class if you're not turning in your homework on a timely basis, which is, I'm probably going to give you some special dispensation this time around, but next time I will not be so lenient. So please be sure and get your homework on time, if only as a courtesy to your fellow students, if for no other reason. All right, so let's jump right into it. I'm going to finish up chapter 1, and we can get out of here. We're going to get out of here a little earlier, I presume, because I'm not telling you the answers to the homework. Hopefully I'll remember to cover that next week. If I don't, ping me in the chat box, and I'll show you the answers. But I'm going to talk about, at first, something that's kind of hard here. I don't know really what else to call this, whatever else to call this, other than, this is my terminology, it's not in the book, but we're going to call it the hierarchy of preference. So when something is preferred over something else, it is above something else. It's at a head in line. And it's exactly what I'm talking about with preference. When you have in the capital structure of a company, the way a company is funded, how it gets its money, really, this is grossly oversimplified, but I'm going to talk to you about 3 main areas that have a hierarchy. One thing is superior to another. One thing has other rights that the others don't. And that's why I call it the hierarchy of preference. And you will begin to see a little bit more about that from me as we move along. The first would be secured debt. And secured debt means that you went and borrowed some money. Let's say in this example, a bank. And the bank got collateral. You borrowed money for a house. Well, they just didn't shake your hand and trust you. They took the house itself as collateral, that if you didn't pay them back, then they owned the house. So that debt is secured by that collateral. It is secured debt. That's number 1 in the stack, right? Number 2 in the stack is unsecured debt. So somebody that loans you money without any collateral. Unsecured debt holders oftentimes would be people like utility providers, employees. A company might own something too. And then the last would be the people that own the company. And why do I say this in the sequence that I say that? If the operations of the business were being wound down and the assets of the company were being distributed, this is the order in which it would go. And if you didn't have enough to pay off the next level, then the next level would not get anything. And so if you were selling the business, if you were winding down the operations of the business, or if you were going bankrupt, this is the order in which people would get paid. The people with secured debt would get paid first. The people with unsecured debt would get paid next. And then the owners of the business would get paid last. And that might sound upside down to you. You would think, well, wouldn't the owners get the money first? Well, no. They borrowed money from somebody else, and they owe it to them first before they give it themselves. So let's delve into this a little more deeply. So, secured debt. What's an example of secured debt? It could be a bank. It could be somebody that goes and, like I talked about a mortgage. Another example would be a factor. A factor is somebody who, if you have a product and you've sold it and people are buying it, and you have an invoice that you have invoiced to somebody that you're waiting to collect and get paid on, there are people that will come buy that invoice from you and get you paid now. And then they will collect the invoice. They're called factors. They charge you a lot for that. But if you need the money to run your business, particularly in small businesses when you're first getting started, factors can be huge in helping you run your business. So it's called factoring your receivables, but those people then own your receivables. So they are secured. So secured debt means you have, security or collateral related to it. A line of credit would be another example where you go. I tell you what, a line of credit in a business is a lot like a credit card. They've given you so much credit that you can spend, and then you charge it up, and then you pay it off. You better be paying it off. Charge it up, pay it off. Charge it up, pay it off when you can. Usually, the security for a line of credit would be the accounts receivable of the business, the inventory of the business, something that's really easy to turn into cash in a really short period of time. It could be securities if the business owns any stocks or certificates of deposit or anything like that. And they would loan you a percentage of the collateral value. So if you, in any of these cases, that would be the case. So if you went and borrowed money on a house, if you bought a $100,000 house, you might borrow $75,000 and put down $25,000 against it, and therefore that is the loan to value ratio. How much of the percentage of the value of that asset will they loan you? And something that's much more easily turned into cash, like accounts receivable, inventory, or marketable securities, they're liable to lend you perhaps 85% of the value of that collateral. So there's lots of different loan to values that are out there, but all based upon some sort of collateral. The next and so the line of credit would be the most liquid. You are in and out on a regular basis. You're borrowing, paying down on a regular basis, just like you would a credit card. But term debt is something different. It's typically for a very long-term asset and would be used to finance something much more tangible, real estate, equipment, and it'd have a note that was paid out over time, like a car note or your house mortgage or something like that. But those are all types of secured debt. Unsecured debt is quite a bit different. Now, in the book, they're going to talk a lot about bondholders because they're almost always talking about bondholders as the debt holders. But bondholders are just another form of lender, so think of it as debt. And so bondholders would be, in a big company like mine, you might go to Wall Street and have them. We might sell a bond, and therefore they would be unsecured because they wouldn't have any specific collateral behind the bond. There are people out there called mezzanine lenders, which means that they'll take a second position in lending to you behind somebody who is secured. Or second lien lenders, they take a second lien, but they're really kind of unsecured behind the people that have the real first position on all the collateral. Vendors, your suppliers, your utilities. If you're building cabinets, the people who are giving you the wood, the glue, the nails, the tacks, the stain, the varnish, the paint, all of those kinds of people would be your vendors. And yes, employees are unsecured debt. So if you're working for a company that goes bankrupt, you would be behind and getting paid before the secured, after the secured creditor. So very important to know where you are and where you are in your stack. And as crazy as this sounds at this point, when people are evaluating investing in your business, lending to your business, they are absolutely unequivocally, everybody has this fundamental understanding of the hierarchy of preference in the back of their mind. That's how the deals are structured. They all want to know where they are in the preference stack. Then, kind of the last is the shareholders. Now, there's a beauty to being a shareholder here. There are two kinds of shareholders. One is a preferred shareholder that goes to the head of the stack because it has some preferences that all shareholders may not have. It may get paid a preferred dividend. It may get its money back before any other shareholder gets its money back. And there's all kinds of permutations of what you can do in and around and for and with preferred stock. But then once you get through that, what's left over is plain old chicken fried, regular red-blooded common stock. And what common stock gets is whatever is left over. Well, why would you want to be a shareholder? Why wouldn't you be a lender? Well, I'll tell you why. Lenders get what they're going to get by contract, period. They're going to get their money back, and they're going to get an interest rate. And you're going to agree to that up front. That's what you're going to get. Common stock, if the business does really great and you make a lot of money, you get all the upside. So the lenders have a defined, absolutely defined return. And the shareholders have theoretically an unlimited upside in the business, which is why it's really important, if you ever want to become wealthy at some point, is to be a shareholder of the business. It's hard to do it just by getting paid. So there are some conflicts out there that naturally arise in business and in life. And the real goal of management is maximizing the wealth of the shareholder, which means the only way a business can really do that is by maximizing the stock price or the value of the business in a private company. But in my company, it's a public company. It's my job to maximize the stock price on behalf of all of my shareholders, right? And but you have to. There are ways to do that. And there are ways not to do that, by the way. But how do you figure out what it's worth? What's a business worth? So the basic tenet of finance is that the value of any asset is the value of the cash flow it can produce to its owners. And that could be in many forms. It doesn't have to be just, hey, I'm selling cabinets, and so I make cabinets, I sell them, and I have profit, and then I distribute that to the owners. That's one way to do it. Or I can build up such a significant business with such a great assembled workforce and customer list and recurring business that the business itself has money where the business could be sold, and that cash flow stream could be distributed to the owners. But all real decisions inside a business are clearly made in terms of their financial consequences. And there may be a lot of other consequences. There may be, dozens of others, but sooner or later, somebody inside that business is going to take a look and see what the financial consequences of that significant decision are. And who's going to do that? Somebody in the finance department, right? And then the other thing is, what's your stock price? My stock price changes every few minutes, right? It's because conditions change, supply and demand characteristics change, the market changes. Our stock went up a little bit I believe it went up recently. I believe one of the reasons Meyer stock went up was just because of the hurricane in Houston. They know that when Houston begins to rebuild, the kind of materials that it's going to take to fix everything down there will be moved on the kind of equipment that we utilize in our business. And therefore, it's going to be very, in the long run, unfortunately, it's sad to say, but it will be positive to our business. We'd rather not have the positive. We'd rather everybody be well there. But it will be positive to our business. And so those kinds of conditions can and will change and will influence the price of the stock. But good managers, good people running the business, CEOs, CFOs, and others, sure full well recognize that being socially responsible and doing the right thing doesn't mean that you are harming the value to your shareholders in any way. And I would argue that it's quite the inverse, that doing the right thing preserves the value of the business for the shareholders. And so certainly at my company and anyone I've ever been associated with, we certainly believe in being socially responsible. Now, it has different meanings to different people, but we mean doing the right thing for the community, the employees, the vendors, suppliers, all of the above, shareholders included. All right, so the book talks about this, and I'm going to try and say it in my words. You may have already gotten it from reading the book, but the notion is that in equilibrium, which is a totally theoretical thing that doesn't exist, but in other words, it's saying if the world was perfect and all things being equal, the stock price would equal its real value. A stock price would equal its actual value. Wow, that's a lot. Well, why isn't that? Well, because our stock prices are based largely, in many cases, based upon people's perceptions and what they think, and how they feel, and what their appetites are, and how they feel that day. And do they want to buy, or do they want to sell? And so, and do they have complete and pure and true information with which to make a determination as to what they believe the value of the stock should be. So intrinsic value is really a very long-run concept, a way to look at the business fundamentally over time and not just the snapshot of that stock price at that exact moment, at that exact moment in time. So if the investor perceptions and feelings and appetites for buying and selling are wrong, then the actual stock price might be different than what it's really worth. And in fact, there are entire investment theses in our investment class of people that look for undervalued or overvalued stocks, and that's what they do for a living. Is they go around looking for stock that's really cheap, and it's pretty sure that sooner or later somebody's going to discover its true intrinsic value, and the stock price is going to go up, and then they're going to make money. Or they look for stock that they go, this thing is just, there's no way the intrinsic value is really here, and the stock price is overvalued, and therefore I think the stock price is going to go down, and they invest in those ways. And so we'll talk about that more later in the course, but to the extent that what they think is wrong from reality, and I don't really even know, I mean, look, I'm one of the top execs at my firm. It's really hard to know exactly what the future will be, right? But it will vary from reality. But the idea is that the people running a business should try and always increase the long-term intrinsic value of the business, even if they would affect the stock price in the short run. And that, to me, that's a fundamental, it's a basic, but not everyone does this. In a public company, once again, like most of the book and most of your professors that follow me, we'll talk about public companies, and I've been the CFO of 2 public companies, but I've spent most of my time in private companies. So you'll hear a lot about private companies from me as well. that there are managers that will manage quarter to quarter to quarter, because each quarter you report your earnings. Go to my website and look at the earnings call that I had about a month ago, where I had to go out and explain to the investing public what our earnings were, what we did, how we did, why we did it. And there are people that will manage the business just to make that quarter, just to make a certain thing happen. And I'm trying to tell you, the book's trying to tell you, the department's trying to tell you that, you know, ideally the right way to run the business is with a very long-term view of what the right thing to do is, and don't just manage quarter to quarter. Now, this is a graphic representation of what I've been trying to get out here. And the point is that there are two things down here: is the stock's actual, real, true, intrinsic value, and then that's what the stock's or the company's price or value is. And they may not be the same. If they are, they would be in equilibrium, where the real, true, honest to goodness value of the business is equal to its price. Well, how do those differ? Well, at the top, you're going to have managerial actions or decisions. We decide to open up a plant in Houston, 2 weeks before a hurricane hits. Or it could be the economic environment. Perhaps, you're in a recession or something like that. Tax policy will clearly affect businesses, and the political climate will clearly impact businesses. I think we all would believe that values of businesses would change if the North Koreans actually, send a nuclear bomb at some target, and it went off. It would change things. It would change the values of all kinds of businesses. Not my personal look. I can't tell you what happened, but certainly I would think that there would be a huge disruption to the values in the stock market if that happened. But is it truly going to happen? Is it really going to happen? Is it or do we perceive that it's going to happen? I don't think any of us really know. It's the same for companies. So, what are the real cash flows of the business? What are they really going to do? What are the real risks to that happening? Are they perceived risks? Or are they real risks? And, you do your best to figure out what you think those true risks are, but that's what it really is. But what I'm trying to say is that's a very theoretical construct. It's not very concrete. On the other side over here, in the perceived, there are people out there, analysts. Their job is to analyze companies like mine. And they literally try and determine what they think the cash flow of my business will be in the future. And they build huge financial models trying to determine and be able to predict what my earnings will be in the future. Then they try and perceive what the risks or, frankly, opportunities are for me to either not make those numbers or to exceed those estimates. And so the analysts would put an estimate of what they think the earnings of the business would be, and those perceived cash flows juxtaposed with the perceived risk would drive the stock's actual market price. And this leaves out some stuff like appetite. Is your stock in finite supply and hard to get, and therefore you have to drive the price up a little bit to get it? Or is there a whole lot of people out there who want to sell and they're willing to sell it, and therefore they'll sell it pretty cheap? But let's just deal with perceived risks and true risks and perceived cash flows and true cash flows, as opposed to all the elements that could go into it. But really the point is that just because the stock market price is what it is on that given day doesn't mean it's actually reflective of the real true value of the business. And it's the job of the financial analyst to try and figure out what that is. Now, there are some things that you probably are aware of, but there have been some recent corporate scandals in the last 15 or 20 years that once again reinforce the importance of business ethics. I kind of alluded to some of that earlier. What it means is the 1/10 of 1% of the bad actors out there cause a lot of increased regulation, corporate oversight, government regulations, all kinds of things that make the lives of all the rest of us much more expensive than they had to be, and much more complicated than they have to be. And so it is important that businesses act appropriately on behalf of all of us. There's no question that the increased globalization of business continues to have a significant effect. There are offshoring, nearshoring, reshoring, all kinds of things moving back and forth, imports, exports. It is very increased globalization is a trend that is here to stay. It will shift, and it will continue to shift by market trends, particularly in the production of physical goods as it relates to the automation of plants. You know, there was a huge opportunity, just for example, for many things to be manufactured in China, where the labor was cheaper. But as the manufacturing processes become much less human dependent and much more automated, then the manufacturing can much more easily take places in places with extremely high labor rates like Mexico, or even higher labor rates like the United States. I don't know a business out there that shouldn't be largely dependent on software. Technology and IT is huge, and it is an extremely important part of all business today, and it will continue to accelerate. And I don't believe we'll ever see any deceleration in the use of technology in business. And as a result of some of this corporate oversight and regulations over here, in public companies, the stockholders now have more of a control over corporate governance. In fact, there are investors out there, when I get a ranking of the people that are investing in my stock, I get this analysis, and it says, are they an activist shareholder, or are they a passive shareholder, or are they moderate? Because people want to know, are there going to be agitators among their ownership base? Are there going to be people that are largely constructive and helpful, or people that are just trying to stir the pot for a quick profit? I spoke earlier to this notion of conflicts between managers and stockholders. The notion is, the book will tell you, that managers are going to act in their own best interest, which may or may not be in the same interest of the stockholders. Well, I'm here to tell you, most of the time that I've been around, managers act in the best interest of the business. But certainly there is a natural inclination among many human beings to act in their own best interest above that of something else. So how do you get the managers of the business to behave the way that the owners of the business would want them to behave? Well, the first one is managerial compensation packages. Now, clearly, how you pay someone will have a dramatic effect on what they do, how they behave, how they work. It may or may not be, but perhaps if you got paid by the hour or paid by the piece, you might behave differently. And the theory is it's really no different with managers either. So managers, senior managers, typically get a base salary that would cover their, kind of their base living. They would get a bonus that would typically be based upon the earnings of the business in that particular period of time. Did you produce profit or not, and how much of it? And then almost always senior managers would have, in a public company, not necessarily in a private company, but a public company would have some ownership of the business, so that if they drive the stock price up, they get to share in that wealth creation. And that way you create alignment of interests between the managers of the business and the owners of the business. The idea is to try and create compensation packages for managers that is closely align the interests with the shareholders as possible. So what else could affect a manager's behavior? Well, these activist shareholders would certainly change their behaviors around how they approach running the business. My particular business is quite unique in that 60% of the business is owned by the management team. That's not usually the case. You would typically see somebody in a normal situation where they're not owned less than 10%, and so there can be more of a conflict between the shareholders and the managers. In my companies, we are the shareholders to a large degree. But the notion of shareholders coming in and trying to take over the board and fire the management team is real, and people will change their behaviors based upon that. You know, if you threat firing somebody, threat someone else coming in and taking over the business, you know, just by somebody else coming in and buying the business, all of those kinds of things would change a managerial behavior. And kind of the last thing, and it doesn't sound normal when I look at it on a piece of paper, but I'm here to tell you this is real, absolutely real, that what the bondholders is what the book calls them, but what people who have loaned you money, they have a different objective than the people that own the business. And it goes right back to the very first thing we talked about tonight when I talked about the hierarchy of preference. Think about where those debt holders are, and call it secure debt or unsecured debt, and where the shareholders are. What do those debt holders want? They want to get paid back, and they want to get the interest on what they loaned you the money. They didn't loan the money just for your good looks. They loaned you money because they expected to make a profit on it, right? So they want to get paid. So they don't want you to do anything that does anything other than paying them back and getting their interest. The stockholders don't have any upside in that. They want you to go out and make some money. They want you to create some value. They want you to drive the stock price. They want you to, get new projects, increase the sales. Let's build a business of value here. Those aren't necessarily in conflict, but they certainly can be. And so the way the book puts it is if you're a stockholder, you're more likely to take on new things, quote-unquote, riskier projects, because if they work, the shareholder will get the reward. The lenders don't get anything extra for that. They're going to get their money back. They're going to get their interest. If you go hit a gusher oil well, the lenders are going to get their money back and their interest. But if you hit a gusher oil well, you're going to get rich. You'll be flying in jets soon. So the lenders, they really don't want you taking on any more debt. Like, hey, I'm here. I want to get paid. I don't want you borrowing money from anybody else that you have to pay them too, because we want all the cash flows and assets of this business available to pay me off, not pay you off or them off. And so that would be a block from you taking on new projects, taking on new opportunities, new growth opportunities, new ways to sell. Just because you sell something doesn't mean you have the cash to sell it. Doesn't make any sense, does it? But if you're making 1,000, cabinets a week and you get an order for 3,000 cabinets a week, it's pretty good. Sounds great. Where are you going to make them? Do you have the people to make them? Do you have the materials to make them? Sometimes that takes money to get to that sale, and many times the lenders really just don't want you to do that. They want you to just keep doing what you're doing until you pay them off. And difficult situation. Now, how do these lenders, or bondholders as the book calls them, try and protect themselves? Well, they put these things in called covenants. And it's a real word, and it's a real thing that we use all the time, and it's a word that's used in finance all the time in all the businesses come around, is loan covenants. What that means is you have to maintain certain financial profiles, characteristics, ratios, etc., to be able to then get to more debt or take on more projects. So they would tell you that you have to have at least, I'm making up numbers here, but it would be very common to say that your earnings of your business have to be at least 1.5 times 150% of the amount of money that you're supposed to pay me in a given period of time. So if I'm supposed to pay the bank $1,000 a month, they would want to know that I'm earning $1,500 a month. So if I don't earn that $1,500 a month, then I can't do anything else but pay them back. That would be kind of a standard loan covenant. They also might say you can only borrow 2 times of your earnings. And so if I made that same $1,500 a month, that would say I could only borrow a total of $3,000. Ooh. Well, what if I've already borrowed the $3,000, or if I borrowed $2,900 from my existing lenders? I can only borrow $100. Doesn't make sense. But that's the kind of notion and the kinds of conflicts that will happen between people that have lent you money and the people that own the business and want the upside. Now, that's really kind of all I have for tonight. I think that has covered Chapter 1. From here on out, we're going to be hitting a chapter a week, a chapter a week, a chapter a week. It's just when we're getting started, things are clunky, people don't have their books yet, haven't gotten their computers right, can't make the lectures play on their computers, that things get slowed down. But after this, it's going to be a chapter a week from here on out. We will have a quiz starting tonight. You will have an entire week to finish this quiz. It should be easy, 25 questions or something like that. It shouldn't take you more than 30 or 45 minutes, maybe longer, but it shouldn't be hard. All the answers are in the book, or in the lectures, or any of the recordings that I may have out there in doc sharing. So it'll be one of those places. But just pay attention, and it shouldn't be hard. You should also be able to save your work and then come back. If you're unsure about something, you just want to go double check something else, it should be fine. So you can do it anytime you want, 24/7, but it's due at 6:30 on Tuesday of next week, when we will turn the availability for the quiz off. All right, does anybody have any questions before we shut down for the evening? All right, great. Thanks for attending, everybody, and I'll let you know when the lecture will be next week. Thanks.